Good morning. We're half an hour from the open in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Rebecca Choong Wilkins with David Ingles.
Good morning. Let's get to your top stories this Monday morning. A risk-off start to the trading week with President Trump set to announce 25% tariffs on all steel and aluminum imports. Now, stocks and commodity currencies are under pressure, while iron ore, as you can see, is making some gains.
China's retaliatory tariffs on $14 billion of U.S. goods also due to kick in today, raising the trade war temperature with no sign of direct communication between Trump and President Xi.
And Chinese consumer inflation getting a holiday boost, accelerating for the first time since August, but you have downward pressures continuing to persist. Good morning. A fresh trading week, fresh news cycle. New tariffs are in play perhaps this Monday, according to President Trump, 25% on steel and aluminum. It's playing out really across these markets Monday morning, where you have a lot of pressure coming through across some of the commodity-related assets here. So Aussie dollar very much in focus. Some of the mining stocks over in Australia. You are getting a risk-off tone across equity markets. We're off by about 0.5%. S&P futures, as you can see, are providing the offsets and perhaps going into the U.S. session on Monday. I mean, these losses might peter out, depending, of course, on what the news flow looks like these next 12 hours or so. Let's flip the boards, please, and have a look at some of these contracts coming online in mainland China. So there we go on your screens. Nothing much to tell you about, although we did mention, of course, iron ore prices on the up in the order of about 0.4 to 1%. That takes us now into the approach to the open today, and I think it's worth keeping in mind that mainland markets had a very good day on Friday. Turnover was nearly 2 trillion. I think number one. Number two is the Hang Seng Tech Index did enter a bull market on Friday. So is this actually that offset that provides shelter to investors amongst, of course, all of the moving things and moving targets here as far as tariffs go? We're called lower going into the Monday open. Bloomberg dollar index, bottom of your screens. So the dollar is on stronger footing going into the fix, by the way, which we'll get to, of course, later on.
Yes, and I mean, tariffs really the focus of today, and I would expect the week as well. President Trump saying that steel and aluminium tariffs will apply to metal imports from all countries, though he didn't specify when those levies would actually come into effect. Just take a listen.
Any steel coming into the United States is going to have a 25% tariff.
What about aluminum, sir?
Aluminum, too.
10%?
10, no, 25%.
25 for aluminum as well?
25 for both.
Let's bring in our news desk editor, Jill Desis, and Bloomberg's chief North Asia correspondent, Stephen Engel. I mean, Jill, just to start with you, what's the very latest state of play?
I mean, at this point, I think we're all just kind of waiting until this, whether it's an announcement or news conference or something Monday, for Trump to give us a little bit more clarity on what exactly these tariffs mean, when exactly they're going into effect. I think a lot of the jitters right now are just over the fact that, I think a lot of businesses and actually other countries kind of figured that they had a little bit more time before, say, you had these big reciprocal tariffs actually go into effect. Now, the steel and aluminum tariffs, I mean, this is coming on the back of last week. We did think that, there was originally going to be, more blanket tariffs on all goods coming in from Canada and Mexico. That ended up getting delayed until March. Now we've got Trump talking about these tariffs. The big question is this something that he wants to take effect effectively immediately, or do we have, various countries and companies actually having time to prepare for something like this? It's also not clear whether or not Canada and Mexico are included on this, given that, there's still a lot of negotiation that's happening between the U.S. and those countries as they face those broader blanket tariffs. So again, a lot of confusion right now, and I suspect that we might not have a ton of clarity until we actually get into the U.S. day on Monday, when the Trump administration will have a bit more time to explain exactly what the thinking is here.
Yeah, maybe Steve could help us sift through the confusion here. What do we know from your
On the China
end?
front?
Yeah, on the China front. Are tariffs already in effect?
Yeah.
Essentially, they would be, yes,
Okay.
right? Because the deadline would have come for those Chinese reciprocal actions, retaliatory actions of tariffs on about $14 billion worth of U.S. goods on 80-plus different products, including LNG and coal, tractors, but not necessarily some of the big key components that they could have tariffed like they did in the first trade war, like soybeans and other agricultural products, probably holding back some ammunition if indeed this Trump comes through on his promise that this 10% tariffs that he imposed last week was an opening salvo. China needs to have a few more arrows in the quiver if there is more action coming from the United States. Also, it led to speculation that maybe the fact that the Chinese retaliatory action gave a 5-day grace period until it came into play Monday at 12:01 is what we assume. So just earlier this morning, that would give room for negotiation. But as we've all heard, or not heard, they haven't had a phone call. And who wants to make that first move? Who wants to pick up the hotline first? Donald Trump, I think I saw him watching the Super Bowl, unless they manage a break at halftime to make that phone call. I don't think a negotiated peace is going to happen today, if anytime soon. So we'll have to, watch this. But the de minimis exemption, that's another development. That was what threw everyone into chaos last week, including the Hong Kong post office, stopped sending packages to the United States. Well, temporarily, Donald Trump has backed away from that because the U.S. U.S. Postal Service in the United States couldn't handle all of a sudden having to inspect what was last year 1.4 billion packages under the de minimis $800 threshold into the United States that didn't require customs clearance, didn't need notification, and was not tariffed. Well, all of a sudden, all that has to be done on 4 million packages into the United States every single day. So we don't know how long that reprieve is going to happen, but I think a lot of e-commerce players, whether in China or elsewhere in the United States, the U.S. Postal Service has to come up with their contingencies because it's probably going to happen.
Yes, I mean, to Steve's point, Jill, about the sort of whiplash that we've had imposing tariffs, kind of backtracking on their implementation, what about the sort of reciprocal tariffs on countries that are taxing, imports on U.S. imports? How much do we know? And again, can we even really have a base case about this?
Well, Rebecca, I think the problem is that you're kind of seeing Trump's thinking unfold in real time. I mean, a lot of this stuff really kind of just happens at these press conferences, or as we just saw in the case of these steel and aluminum tariffs, just, on Air Force One, where he's just kind of riffing. What we do know about this sort of universal tariff plan or reciprocal tariff plan is some stuff that Trump was saying at the White House last week on Friday, where, he was implying that basically everyone was going to be affected. I mean, he's kind of made the idea of reciprocal tariffs a pretty substantial part of his campaign, so that's not entirely surprising that he's kind of coming out and just reinforcing that. He did kind of suggest that maybe some kind of blanket reciprocal tariff plan would be sort of the replacement for this 10 to 20% universal import duty plan that he had talked about during his campaign last year. But again, we just don't really know exactly what that looks like and when it's going to take place. I mean, we have still, again, the Canada and Mexico tariffs that have just been delayed for a bit. We still don't know how that's going to resolve. He also suggested fairly recently that he was going to tax the, EU imports, so kind of get into something there. And so it's kind of unclear, again, how much of this is, part of these specific targeted tariffs, whether on countries or certain products, or whether it's feeding into this broader, sort of universal reciprocal tariff plan. Again, just a lot of confusion. Maybe this week, as we kind of get the strip feed of these different, specific plans, we'll actually get a little bit more on what exactly all of this means.
Team, thank you. Jill Desis there, our news desk editor, and Stephen Engel, our chief North Asia correspondent. Just to mention as well, we spent 7 minutes basically telling you we don't know a lot of things at this point in time. Markets are asking questions later, though, with risk assets on the offer, right, and the dollar is bid. Just one thing to note, though, our team at Bloomberg Intelligence have put out a note here as it pertains to what the impact would be on China, for example. They're basically saying that China will hardly be affected if in case that does come into play, because China hardly exports the metal. It's Canada you want to pay attention to. Alcoa accounted for 76% of total U.S. aluminum imports.
I'll just add to that. Also, South Korea, Japan, Taiwan, Asia's biggest steel exporters to the U.S. there. So again, this risk that it's actually going to be, some of these U.S. allies that very much were able to avoid getting into the fray last time round, in fact, perhaps were beneficiaries last time round, going to be finding themselves in a vulnerable spot.
Yeah, there we go. Sifting through the data, what we know so far. Now, what do you do as far as investment goes? What are your, the sort of shelters amidst the storm here? And despite, of course, the trade war tensions, JPMorgan comes on in a couple of minutes. Yuejue has a relatively optimistic outlook on global growth. Joins us with a couple of her strategies coming up next. Counting down to the opening bell, 20 minutes away in Shanghai, in Shenzhen, and here in Hong Kong. Good morning. You're watching The China Show.
It's a busy open to the week, Dave. Really a lot that we're watching. And in some ways, it's really a tale of two big narratives for markets. On the one hand, we have the tariff stories. We don't know a lot, as we were just chatting. We're still waiting for clarity. But again, of course, that's currently a currency story. We'll be watching for the yuan fix. But on the other hand, it is also this tech rally story. And in fact, sort of coincidentally and conveniently, these are really both stories that came in since Trump's inauguration, when we had also the launch of DeepSeek. That's bringing in some of these very sort of bullish bets when it comes to cheap Chinese tech stocks. The HSI tech, of course, entering a bull market. King D there just also flagged because it had this sort of huge fire up, I think upwards of about sort of, what was it, 20%, Dave? But yeah, this big kind of bump
Crazy
up
day.
in that name particularly. Elsewhere, we're also entering the window for credit data again. And finally, just this BYD story. I just was looking, BYD had the best week last week since November 2020, and it's really in anticipation of what we might hear today. We have this event. They're going to be talking about some of their latest developments, particularly some optimism. We have the likes of sort of Goldman Sachs coming out saying we might hear these sort of important updates when it comes to their autopilot program. So just another name to keep watching today.
Yeah, and that's really on the back of some prelim industry data that we got out of the Passenger Car Association. I think it was late on Friday, just to sort of have a sort of industry-wide blanket to this going into the open today. Well, let's try and make sense, particularly the first bit, right? Is it tariffs or tech? That's the major offset here for Chinese equity markets, which entered as Rebecca was alluding to earlier, entered a bull market on Friday on the tech index. Yuejue, multi-asset solutions investment specialist, is here with us out of JPMorgan Asset Management. Good morning.
Good morning.
Your thesis remains tariffs perhaps won't matter as much because growth still seems resilient. Is that an accurate way to describe the thesis?
I think our overview is still relatively positive. We do think that there are still a lot of uncertainties in terms of the timing and the ultimate scale of the tariff. So there will be a lot of volatility and uncertainties. But for now, based on what we currently have, we think that the global economy is still looking kind of strong and healthy. So we have a relatively positive view on risk assets, but we have actually moderated the positions given the volatility that we're seeing. So we have taken some profit.
And I want to sort of just stress test that optimism that you have on US stocks a little bit. One, the sort of boomerang effect that we had the first time round, tariffs really did hurt US stocks because of that global integration. And the second element that, of course, last time there was a lot more run up for the S&P to move. Now we are having the sort of really red hot S&P, really red hot US markets, and of course the story of US exceptionalism. Why isn't that concerning you as much as perhaps others?
Yeah, I would say that these are fair statements, and we do closely monitor, on the tariff stuff, because one kind of difference this time around is that the valuation is actually quite high. If we look at what happened in Trump's first term, the multiples actually contracted during, the tariff announcement. And that's why we don't think that given what's happening on the political front, there will be there will be a much upside in terms of multiple expansion. But then on the other hand, if you look at the corporate earnings, they continue to deliver, right? So that's why when you put these two pieces together, we're still relatively positive. And we think that if we look at the outlook of U.S. equity market, a lot of that is still coming down to earnings. We don't really think that the multiples will expand from where they are. But as long as the corporate earnings continue to deliver, I think we're still relatively comfortable.
What about how the recent sort of emergence of DeepSeek, just as an example, has challenged that notion that we might need to rethink some of the assumptions around, well, U.S. equities, because that was really underpinned by just this massive tech play?
Yeah, I think over shorter term, there's obviously, I think as some of the market participants have put in it, it's a destruction, right? A destruction to the destructors, right? The AI. But when we look at over medium term, the fact that DeepSeek and maybe other innovators coming into the market is actually making AI as a more accessible tool for the smaller companies and also, companies that are outside U.S. who don't have that much capital to put in a lot of money into CapEx. So we actually think that, when the more innovative players come into market, that on aggregate is actually creating more demand over medium term. So yes, over shorter term, we'll continue to see, rotations and the volatilities depending on, what is the next assessment in terms of these new models coming into the market. But over medium term, we do think that the AI trend will continue.
We've seen that shift somewhat last week to some of the Chinese plays, for example. Do you think is that something that you're looking to add exposure to, or do you think that rally's gone a little bit too quickly right now?
We actually think this is actually a very good reminder for the global investors to look at the innovation capabilities of some of the Chinese players. And I think over the past, few months or years, people are so concerned of all the other headwinds around China. But then if you look at individual players, their capabilities, there are still kind of interesting stories in the China market. So that's why you are seeing these rotation in the market. But I think over a medium term, that's still coming down to the macro environment where, we are very much monitoring the NPCs coming up, whether there will be more fiscal kind of impulse that's going to be announced.
I want to turn also just thinking about tariffs. How much of it is a risk to your thesis that the tariffs revenue might sort of be a means to an end rather than just an end in of itself? If tariffs are actually a way of raising revenue rather than just a way of negotiating leverage, how damaging or how much does that change your thesis?
Yeah, I think that's very much the key concern that we have or the key potential risk that we're monitoring. I think when we look at tariff, there are essentially two categories, right? It's the way for him to negotiate the non-economic front, but it's also a potential longer-term structural thing that he wants to put in place. So I think the key risk to our current thesis is very much if the tariff will be a sustainable, longer-term trend that will be in place. And that means that, future growth may be smaller and inflation will stay for longer. And that's definitely a headwind for the economy, not just the U.S., but global. But I think there's also another key risk that markets need to be more kind of, monitoring, which is even if tariff settled in a more, positive way over medium term, the longer the negotiation takes place, the longer the uncertainties around this on again and off again, corporates may turn defensive and conservative when it comes down to CapEx spending. And that will itself become a kind of a concern for us.
You mentioned at the top, you've taken some profits out of the U.S. Where is that allocation now? Is that in cash? Are you waiting for a catalyst or a pullback? Like, what's the thinking right now on that?
So we are, overall, the overall book is still have a moderate kind of overweight in equity. But within that, we have an overweight in U.S. equity and Japan equity. I think we do think that, the reflationary environment in Japan seems to, be quite sustainable. So we have a positive view on Japan. Outside equity, we have a neutral view on duration and also a positive view on U.S. credit.
Okay. Nice to see you. Have a great week ahead, and hi to the team, rest of the team. Yuejue, they're multi-asset solutions investment specialist at JPMorgan Asset Management. All right, one stock to tell you about, Dongfeng Motor, up 15% in your pre-markets. Let's flip it back the page, please, if we can. That's down to this, and we're just looking at its controlling holders planning a restructuring. We'll get you more details on the story. And going into the open today, under 9 minutes away, we're called higher. Last we checked. Happy Monday, by the way. This is Bloomberg.
In some of the global headlines that we are following this morning, President Trump has suggested that Elon Musk's government efficiency team has found irregularities while examining data at the U.S. Treasury Department. It's unclear if the issues stem from government debt or payments processed by the Treasury. Musk's so-called Department of Government Efficiency has been seeking access to Treasury payments data. Israel has pulled troops out of a belt of land in the Gaza Strip after recovering 3 more hostages. While the initial truce period is now half complete, mid-level Israeli envoys have set off for a new round of talks in Qatar. Any full Israeli pullout from Gaza will have to be negotiated in the second phase of the deal, along with a Hamas handover of remaining hostages.
All right, going into the Monday Open today, 0.4% is the modest upside in the Hang Seng Index. We're looking at some weakness coming through across not just the Chinese currency, but certainly across a lot of the trade-related currencies out there. Obviously, within that sort of complex, the Aussie is very much in focus within as both a trade and also commodity-linked currency. Although all that being said, we are poised to open higher and really build on what's been so far, in case you lost count, 4 weeks of gains across equity markets. Hang Seng Tech Index, again, is on the up in the early goings after entering a bull market on Friday. Okay, a couple of changes to some analyst ratings here. So you have Win Macau and Sands China being cut to Switzerland. Neutral, I'm kidding, there at Citi. Cut to hold at HSBC. And we'll talk about Prada in a moment because they're also getting a change as a Haichong International. A couple of other names that we're tracking here, e-commerce stocks. Yeah, absolutely. Again, this is a reaction to some of the whiplash that we're seeing. Trump now delaying the suspension of the de minimis. You have the likes of Temu, Shein, really who depend on this rule, essentially duty-free access via these small packages. Alibaba up 3% in that pre-market. Yeah, a boon for e-commerce. Yeah, we're looking at Alibaba. I think it's the first time since, give me a moment while we change the page on that we're trading above 100 Hong Kong dollars a pop. We're also looking at some of the mining stocks on the back of the conversations here around. So you have the Chalcos of the world, although, our folks at Bloomberg Intelligence think it's a very sort of limited impact scenario we're looking at as far as that is concerned. This is Bloomberg. Welcome back. You're watching The China Show. We are counting down to the open of markets, and it's going to be a busy Monday, we think. I mean, really, we're dominated by this tariff news, but we've had really 2 weeks of kind of this whiplash, this back and forth and reversals on what really President Donald Trump means when he says we're going to tariff. Yeah, well, he's going to threaten, and then he's going to put them in place, and he's going to take them back, right? Yeah. And I think that's really the cycle that we're in right now, to the point we were making earlier on. And hence we're watching e-commerce stocks, for example, right? This back and forth between, are these parcels going to be covered? You had the U.S. Postal Service react. You had Hong Kong, the post office saying, no, we're not going to do anything. And then we have Alibaba up 3%. And on top of that, you have this sort of AI theme that underscores the rally taking place here in Hong Kong, maybe as a shelter amidst all this uncertainty and back and forth. So the CSI 300 is up 0.1%. It's worth pointing out that on Friday, turnover actually was nearly $2 trillion for the first time since, I believe, October. So there's a lot of buying taking place in this market. So far, we haven't gone to inflation. We'll talk about that in a moment here. Let's flip the boards, please, and have a look at Hong Kong. And the story there is one where tech stocks are continuing, up 1% now. In the first few minutes, extend that rally. Alibaba's up 3.5%. You have Tencent, not so much joining that rally so far. Meituan is at 1.2%. And, did I catch a glimpse of Dongfeng there, or am I rethinking? Am I seeing things? Probably the latter. You might actually see that come up full frame coming soon on this restructuring that, according to this filing on Sunday, the controlling shareholder of Dongfeng Motor Corp is planning a restructure with other central SOEs, which may lead to a change in the controlling shareholder, but will not result in a change to the actual controller. Yeah, there we go, on your screens, limit up effectively across most of the listings there. Let's have a look at some of the mining stocks in focus, some of the steel makers, of course, Baoshan. You have Inner Mongolia, which are the two biggest ones, of course, on market cap listed onshore. Swire Properties warning, well, full-year warning of a net loss, but they're also saying it's not going to affect the dividends, so don't worry about that. And King D, to the point Rebecca was making earlier on, this AI plea continues to give. Stock closed up 14% on Friday. We're up a further 3% right now. And a couple of changes to analyst ratings. Citi, amongst others, cutting Win and Sands to hold, and Prada is being reinstated at Haitong. 81.87 is the price target. Reinstated, outperformed there on that stock.
Yes, and I mean, we're also in this window for credit data, but also we're getting in now the sort of influx of data when it comes to Chunjie, the Spring Festival. China's consumer inflation accelerated last month for the first time since August, boosted by that burst of household spending we saw around the Lunar New Year holiday. Our China correspondent, Min Lo, joins us with more. I mean, how much of a boost is this? And part of this also comes down to timing, because we had a very early New Year in China this year versus the previous year.
Yeah, you're right. So last year, the Lunar New Year had fell entirely in February. This year, it started in January. So we had that bounce from, gift giving, the Lunar New Year travel, the box office record, the train trips record. So that really all showed up in the January CPI. It was 0.5%, beating estimates of 0.4%. And you can see the trend that's really bucking that month-on-month decline since August. But Goldman Sachs and Bloomberg Intelligence as well are saying that this is likely a one-off bounce that could turn into a drag in February, because we have then the very high base from the February Lunar New Year spending last year as well. So but again, this is likely to be a 2-month sort of seasonal distortion here. We're expecting maybe a deflation next month, but that's not likely to keep sustaining month on month as well. But the upside here is that while the underlying prices perhaps still remain pretty slack, the upside is that it gives the government more reason to push out more demand-side stimulus, and that's something we're watching for in the National People's Congress.
Well, I mean, certainly the producer prices did give us something to think about as far as, the need for more support here. Yeah,
we still continue to see this big dichotomy between the CPI and the PPI, because the PPI, we're still seeing negative print, down 2.3%, the 28th consecutive month of decline that we're seeing. It remains steady from the previous month. Again, worse than estimate of negative 2.2%. So this shows that, the fundamentals, the factory gate prices still under a lot of pressure, and there are questions, growing concerns now about whether these factories can sustain the blow from the Trump tariffs as well, because they're already operating on very razor-thin margins. They don't have a lot of room to lower prices further. So concern around that deflationary spiral and how hard it would be to break out of that.
Min, thank you. Min Lo, our China correspondent there. All right, let's bring in Erica Tay right now to talk us through, of course, where she thinks and what the implications are of the latest inflation numbers coming through here out of mainland China. Well, Erica, happy Monday. Hope you had a good weekend. We're trying to figure out the tariff story, and I'm sure you are too. Maybe we'll start off with the inflation print very quickly. How much weight do you think we should be putting on this latest inflation report?
Not a lot, David. So we, as mentioned earlier by Min, this bump is likely to end up as a drag in February. So we may possibly see a negative inflation in February for the next reading, but just as the January boost is not a sign of underlying price pressures firming, the February negative reading shouldn't be read as a sudden weakening of China's economy as well. I think going forward, inflation is looking to creep up very, very slowly and probably average about 0.9% for the full year.
Erica, just help us make sense of some of the latest statements we've heard on tariffs from President Donald Trump. Where are you and how are you factoring in this idea of reciprocal tariffs? Has it changed your base case when it comes to wherever you think we end up on tariffs on China for 2025?
Yes, so reciprocal tariffs look like, the trade war front has opened up to a wider range of targets. So primarily countries such as India and South Korea that have higher tariffs on U.S. goods than the other way around. So I think the good thing is that, there's a greater coalition of countries or economies that are banding together and hoping to get around this U.S. trade tensions. But the downside is that other than negotiating with Canada, Mexico, and China, now the Trump team has to negotiate with many more parties. So that, I think, might delay the chance of a China deal.
And Erica, as far as markets go, they're largely staying away from a lot of the trade-related financial securities. Actual industry is they're front-loading a lot of the exports that, ahead of these tariffs and ahead of the uncertainty. I want to throw up a chart here just for, just to underscore that point. Taiwan released export data on Friday, and, the record amount that we saw shipped to Mexico, up nearly 500%, is indicative, I guess, of the front-loading taking place. My question to you is, how much growth did we borrow from the future here?
I think if you look at what's going on, there might be more front-loading despite the actualization of 10% tariffs on China goods into the U.S. Why? Because businesses might be thinking that tariffs are going to get worse. So you might see actually instead of trade or exports to the U.S. Fading in February, you might see even an acceleration because companies are bracing for an even worse scenario.
Erica, I want to talk about that uncertainty, about how companies are in fact managing, the sort of flip-flopping when it comes to tariffs, and what the potential cost is to global growth here if we do see this broader-based passing on of tariffs for popular goods and sort of very widespread, far-reaching tariffs.
Indeed, Rebecca. So I think there's two negative sorts of impact on economies. First is the actual tariffs, but secondly, the dampening effect on growth from uncertainty is nothing trivial. So we think that if companies expect that tariffs might go even further, they're not likely to make long-term investment commitments that involve huge capital outlays until the coast is clear. So because of that, economies in Asia might actually see a slowdown in manufacturing fixed investments until there's greater clarity on the trade front.
Manufacturing fixed investments is really one, to just borrow that phrase, Erica, is really how the Chinese have managed to, keep growth up. I'll even add in exports last year. What currently are your projections for the impact to Chinese growth because of the tariffs, and what do you think the offset will be from the NPC next month?
So manufacturing investments in China is a tale of two pictures. So state-owned manufacturing investments have been growing at quite a healthy clip. But the flip side is private sector investments have been slower to pick up. And I think all these trade tensions don't help because especially small and medium enterprises, they have been actually supported by some of the de minimis allowances in the U.S. So if there's uncertainty on this front, they might actually, pull back and say, let's wait a second for the de minimis dust to settle before making new business investments.
Erica, thank you so much for taking the time to speak with us this Monday. Have a great week ahead. Erica Tay, the economist at Maybank Investment Banking Group. Just a brief look at Dongfeng-related stocks here, and certainly the news, according to the filing, it was up as much as 80+% at one point. Here we're up 20% right now. So the filing on Sunday, the controlling shareholder is planning a restructuring with other central SOEs. It may lead to a change in the controlling shareholder, but not an actual change to the actual controller. Does that make sense? Well, we'll try and make sense for that a little bit more later on the show. Stocks are responding on your screens. Plenty more ahead. You're watching The China Show.
We are checking steel and aluminium prices here on your screen. Iron ore down just a touch as well. Really, that's coming after President Trump said that the US is going to slap tariffs on those metals from all countries. For more on the impact, let's bring in Bloomberg's Martin Ritchie, who joins us from Shanghai. Martin, just to kick off, explain to us where we're likely to see the most exposure here and where China comes into the picture.
Yeah, OK. So shades of the last Trump administration here when steel and aluminum imports were a big focus for Trump. Last time it was all about China, about protecting against Chinese imports. But this time, Trump appears to be aiming for a very broad 25% tariff on China, on aluminum and steel imports from all countries. In terms of who's most exposed, Canada tops the list for both steel and aluminum, especially in aluminum. So 56% of US aluminum imports come from north of the border, and then 15% from Mexico, 12% from Brazil. On steel, Canada's also top, followed by Mexico and Brazil. So we'll be looking at what's the reaction from those countries in particular.
What are potentially the indirect sort of effects then we're looking at as it pertains to Chinese mainland? Because as you perhaps underscored the premise here, China has largely, not completely, largely sort of divorced itself from this specific sort of trade route.
In terms of the China angle here, look, the direct flows of both metals, steel and aluminum to the US are fairly minimal. We're talking very low single-digit percentages in terms of overall US import volume, so they're not huge. And a curious thing is that back in the last Trump administration, as we said, there were also 25% tariffs on Chinese imports, which are still in place. So it's possible, we don't know yet, that that this will be double tariffs on Chinese imports. The kind of read-in for the China's exports or the China economy is probably fairly minimal, we would say. We've seen metals prices react in a fairly modest way so far, just because the volumes of that trade are fairly low.
Martin, thank you so much. Martin Ritchie there in Shanghai for us. Now, despite the tariff risks right now, markets here in Hong Kong and in mainland China are rather steady. In fact, CSI 300 was up in the early goings. I think it's believed it's a little bit lower right now. When you look at the Hang Seng Tech Index, actually is going the opposite way. That is, in fact, extending the bull market that we saw on Friday, 1.2% right now. So really, is Chinese tech providing that hedge to everything that's going on? Let's bring in Annabelle Jewelers here to talk us through the deep-seek effects here are playing out, I believe.
Well, that's it. Yeah, I mean, you were talking about on Friday the Hang Seng Tech Gauge, for instance, entering bull market territory. So it does really seem that investors sort of are recalibrating the risks around how much is China tech really exposed to the geopolitical side and how much can it continue to benefit from what has been perhaps a very large innovation in how AI tools are developed with DeepSeek, of course, that follows a small language model approach instead. So in terms of the discount that you see as well, I mean, this chart really puts it in perspective, but China tech stocks are certainly trailing their US peers, so there's a lot of room for catch-up here at play as well. But, companies like Alibaba, Tencent, Baidu, for so long we've talked about the risks that they get from the Chinese consumer and the downturn of the economy. Now perhaps there's rethinking around what is the potential here instead. And so you're seeing that rise coming through. Actually, our Bloomberg intelligence team has been looking into this as well, and they've put out a report this morning looking at the AI sector outlook in particular, and what they're saying is that There is renewed interest, and we're seeing that, of course, expressed through the tech stock rise that we're seeing because these names are mostly domestically focused. So names like Alibaba, for instance, they get 90% of their revenue from mainland China. That can help protect their revenue streams and insulate them a little bit from the tariff risks as well.
And sticking to sort of that AI theme, we have numbers coming from TSMC, Hon Hai coming later today. Just tell us, what are we expecting to see? And also, I guess, does the context that we interpret these numbers change given this backdrop that we're seeing with DeepSeek?
Yeah, that has certainly changed, I think, just over the last couple of weeks because, yeah, we had DeepSeek. I think it was interesting as well, through all of the earnings calls last week, Amazon, Alphabet, they were all talking about what is the risk from DeepSeek? Is it actually having an impact on their business? And so these are not exactly likely to show up today specifically just because these are monthly sales figures. So a bit of a quirk of the Taiwan exchange is that if you're listed there, you do need to report monthly sales figures, and then that builds into the quarter release at the end. And then that's the point, of course, in the earnings call, you get more context on these. But still today, we're going to get more of a sense, is that spending on AI extending into 2025? This will be sort of the early indication. Of course, these are two major beneficiaries from the AI boom. Is that extending, and is DeepSeek and that risk that maybe we've sort of overspent at this point, is that starting to have an impact as well? But certainly, I mean, we saw big capex announcements last week in those earnings from big tech as well in the US. You know, we'll see how it shows up today.
Thanks, Annabelle. Our tech reporter, Annabelle Jewellers there. And in some of the corporate headlines we are also following this morning, Bloomberg's been told that activist investor Elliott Management has built a significant stake in British oil major BP. Sources say Elliott wants to boost value by pushing the energy giant to consider transformative measures. Its shares have lagged peers, including Shell and ExxonMobil, over the past 5 years after a failed bet that oil consumption had peaked. And Elon Musk says he's not interested in buying TikTok's US business and hasn't put in a bid. Musk's comment last month at a conference in Germany was first reported on Saturday. He said he didn't have any plans for what he would do with TikTok if he did own it. Bloomberg reported last month that Chinese officials were weighing the possibility of Musk buying TikTok. There is plenty more ahead. We'll be following the tariff story very, very closely, and of course what we're seeing in e-commerce, the rest of the Chinese consumer space, and this rally we have seen in tech. Stay with us. This is Bloomberg.
Right, lots of moving parts to the equity market. We'll start things off here with Dongfeng and that filing on Sunday, which really moved the stock. I think it's an understatement. Up at one point, up as much as 86%. We're now just off highs, as you can see here. Well, the story here is its controlling shareholders planning a restructuring with another state-owned enterprise group, and other companies that actually filed similar statements have also been on the up, which might result in a change in the company's controlling shareholder, though the actual controller will remain the same. So this might be just a little bit of corporate finance rejigging here, which might result in, as you can see on your screens. Okay, some of your steel producers onshore and offshore here on your screens coming up next. You have Bao Steel, so this is really more the upstream sources of steel itself, so everything from Bao Steel all the way down to Angang, which is listed, of course, A and H shares on your screens. Aluminum, Chalcos of your world immediately comes to mind. And our guys at Bloomberg Intelligence have put out this note here. The metals and mining team have come out and said, you know what, if you want to look for an impact on these potential tariffs, don't look to China, look to Canada. That might be more in line. In fact, the Alcoa, to the point Martin Ritchie was making earlier out of Shanghai, Canadian producers such as Alcoa accounted for, get this, three-fourths of total imports of aluminum into the U.S. in the first 10 months of 2024. China's minimal exposure here.
Yeah, and just worth bearing in mind, of course, we are still in this sort of mid, 30-day period of reprieve between US and Canada. So a deal is going to have to happen fairly soon if they're going to extend that reprieve. There's a real question mark now hanging over Canada and the hit potentially to its exports.
Yeah, and how does any announcement today, that's right, how does any announcement today from Donald Trump, will that supersede this sort of 30-day reprieve, or is that going to be part of what will be discussed? It's a lot of confusing things, really.
I mean, to your point, it does also reflect what we're sort of seeing in markets and even in China markets today, this cycle of sort of reaction and then reversal. We're seeing that reversal come through when it comes to the eradication of this de minimis rule. We're kind of going back and forth now. Actually, it's not going to come into effect, but that's offering a bit of reprieve for Chinese consumer names.
Yep, a lot more reason for you guys to stay tuned here to the shows as we try and sort the after effects of this. Erica Tay, who joined us early on from Maybank Investment Bank, basically said that if we did see a lot of front loading, do expect more front loading to still be in play right now amidst corporates really not knowing where this one goes and on the prospect of higher tariffs ahead. The CSI 300 flat right now. Hang Seng Index is building on those gains. Plenty more ahead. This is Bloomberg.
Welcome back to the China Show. Here's a look at the HSI about a half an hour into the session. We are, 1.5% higher. We really had the sort of two narratives battling out. On the one hand, this tariff story, but on the other, this story about deep-seek optimism around these really cheap Chinese tech names. Of course, we did have the HSI tech index entering that bull rally at the end of last week. This question of whether to what extent Chinese names are now catching up with their US peers, Dave?
It's, we were, for the better part of the last 3 years, we were waiting for a major catalyst to, for investors to take advantage of these cheap valuations, everything from the macro picture improving, do we get inflation needing to come through the housing market, the Fed, and lo and behold, up to now, it became, at least for now, a startup in Hangzhou that kicked off this rally.
You know what's so interesting? This time of year, normally, what we're talking about is just all about the MPC. Is it, is this MPC going to be make or break? What is the impact on the market? Really, investors sort of grappling with doubt, like will they, won't they, about fireworks. We've hardly talked about the MPC over the last couple of weeks.
Yeah, but make no doubt, right? Like a lot of people are watching that as potentially there's now a bigger stake.
Sure.
For as far as potential catalyst there because of just everything that's going on and the offset that they might need to put in place. Maybe a little bit more insurance, in fact, that, I'd be remiss of my duty if I didn't mention some of the notes coming through there of expectations being quite high. We have some lines coming through. We'll talk about this in a moment here, but let me just mention as well, so as far as volumes go, we're about 150% heavier than usual for this time of the day on the Hang Seng Tech Index. Asia ex-China is, apart from Chinese tech specifically, everything else is either slow to come out of bed, falling out of bed, or just really waiting for more clarity as it pertains to tariffs. And a lot of the benchmarks you see on your screens, Nikkei, Kospi, ASX 200, are all seeing some level of downside right now. Okay, I was vaguely alluding to this, but yes, here we go. Some breaking lines coming through.
Yeah, I just want to interrupt you, Dave. There are some breaking lines coming through, really about Shein. So Shein asking Chinese suppliers to add production lines in Vietnam. This is really the diversification kind of nearshoring story that had been waiting to see to what extent it's going to be playing out. Shein apparently asking Chinese suppliers to add production lines in Vietnam, Dave.
Yeah, this is okay. So, well, for one, that market opens up this hour. We'll see if there's any market reaction there. Later on in the show, in about 30 minutes from now, we have HSBC's global head of global transport and logistics, and also Fitch coming on to just help us understand how tariffs are affecting exactly this, right? How things are being rejected across the supply chains, how much how much give and slack there is for companies to be operationally flexible given all the news out there. So we'll table that story for now. But really on the tariff front, from a market's perspective, am I worried about that, or is AI, Chinese AI and tech, enough of an offset? Here are the thoughts from JPMorgan. We talked to them earlier on.
We actually think that when the more innovative players come into market, that on aggregate is actually creating more demand over medium term. So yes, over shorter term, we'll continue to see rotations and the volatilities depending on what is the next assessment in terms of these new models coming into the market. But over medium term, we do think that the AI trend will continue.
Marvin Chen, our Bloomberg Intelligence equity analyst, is here with us to talk us through these AI developments are providing, Marvin, at least investors, some shelter from the storm.
Yeah, I mean, if we look at China tech as a whole, we have a strong domestic focus with over 85 to 90% of revenues generated domestically. But more broadly, we think this tech rally really reflects the progress that China has made on its domestic agenda in terms of new productive forces, self-reliancy goals, and it's been more than just about AI. We have news on autonomous driving that has lifted the EV makers, and these are the areas that China has marked as growth drivers going forward.
Talk to us too about valuations and your outlook, particularly as we're sort of heading into earnings season.
Yeah, I mean, China tech has obviously re-rated, but we still think valuations are relatively undemanding. If we compare China tech to, say, the Mag 7, the valuation gap has narrowed by about 5 to 10 percentage points over the past month or so, but China tech is still trading at a 50% discount to U.S. peers. Now, obviously, there is some geopolitical risks that need to be factored in, but we think that the gap due to AI leadership can narrow going forward, particularly if the focus shifts from chip demand to broadening out to the entire AI ecosystem.
Do we know enough about just the revenue boost that we might get? I think not a lot of people have really gotten into that question right now. So people seem to be buying almost a blanket buy across Chinese tech without really understanding who really benefits from all of this and in what way.
Yeah, I think, the initial phase was all about the chip demand, right? The chip makers are benefiting. Now I think we're more moving into the software services, the cloud data center providers, and more broadly, the entire ecosystem. So I think as we move into the next phase of AI development, China does stand to benefit from a little bit more of this.
Marvin, just before you go, do you think enough people are talking about the concern about potential bubble bursting here?
I mean, I think valuations don't suggest we're in a bubble yet. And as the previous guest you had on suggested, the AI trend is going to continue. So I think we're still in the very early stages, particularly for China.
Great. That's our Bloomberg Intelligence Equity and Strategy Analyst, Marvin Chen there. Now, sticking with markets, our Bloomberg MLive strategist, Mark Cranfield, joins us from Singapore. Mark, it doesn't look like some of the sort of tariff surprises that we had overnight through the weekend are really kind of jolting markets. It does look like tech in China, at least, is perhaps providing an offset. How optimistic are you? Or what are the reasons to be optimistic on this Monday?
I think we should probably reassess that as Mr. Trump's aspirations for tariffs rather than his plans. I think sometimes we read a bit too much into that. He says a lot of things about tariffs, and sometimes they haven't really been thought out very clearly. So he may want to put on some tariffs. Whether he does or not, we'll find out. But then that's life for a trader these days under the current president. In terms of China and the tech story, you were talking about the MPC earlier, about they're not really focusing on that. Well, there's a significant shift going on here, which is very important for investors. And they will be hoping that the MPC doesn't do anything, doesn't say anything about tech at all. Because one of the things which has gone wrong for investors in China over the past few years is that from time to time, the Chinese authorities have come in and they've set back situations where private sector has been doing well, certain parts of it have been booming, and then the Chinese authorities come in and either put some restrictions or they say something which makes everyone dial back their investments in that sector. The best thing they can do right now is not to say a word about what's happening in the Chinese tech space and just let it run. Because as your previous guest was saying, the valuations from Chinese companies are still very attractive compared to the US, for example. So if investors can be persuaded that China is almost ring-fencing itself, that it's creating its own domestic tech market, which is very strong, has a lot of investment flows going that way, and the Chinese government just stand back and let it happen, it could go a very long way. It could still run for a lot further. That's a reason to be optimistic on a Monday.
Right. And Mark, as if for global investors who might still be, I think, waiting for more, let's say, waiting for more data, waiting for more clarity, whether or not this is, this Chinese tech trade is FOMO or JOMO, the joy of missing out, how do we need to be thinking about, they need to be thinking about Chinese tech at the moment? Is it something that they are cognizant that they might miss? Is that a performance issue at this point?
I think you also have to be a little bit careful here about what the global investor base wants and what the domestic investor base wants here. There will still be plenty of people outside China who will be a bit skeptical about putting money to work in the Chinese markets itself. They will still be a bit concerned. Doesn't mean to say the rally can't go on for some time, because there's a huge amount of money swirling around in Chinese funds anyway, which will stay within China. So that story probably is supported anyway. Foreign investors will mostly look at what happens in US ADRs. They'll look at the stocks which are listed in Hong Kong. That can also run in parallel as well. There are many different elements to this whole thing. Importantly, they'll also be looking for guidelines in terms of, is any of this tariff talk actually really going to impact in the short term, or is it long-term issues which eventually will find a way around? Those things have to be decided as well. In the meantime, the whole thing about DeepSeek and the way in which it's able to create relatively cheap products is a win for so many people who probably are only just getting involved now. So this on its own, the DeepSeek story, probably has a long way to run, and investors can see that could add value to a lot of different companies.
Mark, just on a separate note here, I'm looking at Canada, for example, because of the potential tariff news on steel and aluminum. Should we expect Canadian assets as a proxy, I guess, to everything else to come under pressure later today?
Well, the Canadian dollar weakened slightly early this morning when those headlines first came out. It's reversed most of that already. I think people will be expecting that if Mr. Trump is serious, that Canada would have some response anyway. What the Canadian authorities have shown so far is that when there's one thing coming out of America, they're ready to counteract it with something else. So it's hardly likely to be the end of the story. I think also traders are just showing how difficult it is to trade. Every time, all these knee-jerk reactions to headlines is becoming a bit tiring for everybody. And I think there's a bit of fatigue about, yet another headline about tariffs. Well, you can't keep on trading in the same direction without something tangible. It reminds me a bit of when North Korea first started firing missiles across the waters towards Japan. At first, we used to get very big movements in bond markets, and gradually they got smaller and smaller and smaller as North Korea continued to fire missiles year after year. I'm beginning to wonder if the tariffs is a bit like this. The more headlines you get, maybe the market reactions get smaller and smaller.
Mark, thank you so much. For a moment, I glanced at my screen to check just in case they did launch anything as we were talking there. No news so far there. Mark, thank you so much. Mark Cranfield, our MLive strategist in Singapore for us. Now, and some headlines out of China that we're following this morning. China has launched a pilot program for 10 insurance companies to invest in gold. Now, the move is part of efforts to broaden insurers' investment channels and optimize their asset allocation. According to the National Financial Regulatory Administration, the insurance firms can start investing in gold-related businesses for the medium and also longer term.
Yes, and President Trump says he will maintain the duty-free exception for low-value packages coming from China, formalizing a temporary reprieve for retailers like Alibaba and JD.com. As part of a new 10% tariff on China, Trump had revoked a de minimis rule that previously allowed small packages under $800 to enter the U.S. duty-free. Questions still remain, though, over just how tariffs on small packages would would be collected. And coming up next, how Prime Minister Ishiba managed his first meeting with President Trump, easing fears that Japan could be next in the firing line for US tariffs. This is Bloomberg.
Now, Japanese Prime Minister Shigeru Ishiba managed to ease fears that Tokyo could actually be the next in the firing line for Trump's tariffs. During his first meeting with the U.S. president, Ishiba secured confirmation of a close security alliance and a plan to deepen economic ties between the two economies without attracting any threats to trade between the two. Let's bring in Brian Fowler, our senior editor out of Tokyo, for us to talk us through. Brian, what seems the general assessment it seems to be that things went well for the Japanese side. Is that a fair take?
Yeah, ahead of this trip, I think a lot of people were saying it was a bit of a gamble for Ishiba. They really didn't know how well he would hold up. We knew that Trump had a great relationship with Shinzo Abe, but Ishiba is a much more kind of down-to-earth, even quiet, a little bit introverted type person. So it was a bit of a gamble. But Ishiba went to Washington, and he managed to combine flattery with an emphasis on what Japanese companies are going to do for the U.S. in terms of investment. And in this way, he showed that that Japan could be behind Trump's America First agenda and contribute to it. And so that put a very positive backdrop to their talks, in which the two leaders found a lot of mutual interest. As you mentioned, global security concerns was one thing. Energy was big as well. Japan pledged to buy LNG from the U.S., which is big for both parties. And then Japan may also invest in the pipeline project in Alaska that's for gas and oil. So that was a big thing for Trump as well. So the bottom line is Japan avoided getting any sort of direct tariff threats to its auto sector or pharmaceuticals. So from Ishiba's perspective, that's a big win.
Brian, from Tokyo's point of view, what is next when it comes to trade and policy? And given the sort of perennial uncertainty over Trump and tariffs, to what extent can Ishiba actually start to plan?
Yeah, I mean, that's a huge question. I mean, Ishiba was back on the ground here less than 24 hours, and suddenly we've got all kinds of new things happening on trade. Trump's talking about reciprocal sanctions, and then he also, of course, has the aluminum and steel sanctions, and that will affect Japan like it will many of U.S. allies around the world. There's a lot that can be done. Japan also puts a lot of tariffs on imports from the U.S. for food and agricultural products, very high tariffs on beef. So there could be room for some negotiations on both sides to come to something that seems more mutually agreeable. We'll see about that. Trump, in his talks with Ishiba, asked the Japanese prime minister to do something to reduce the U.S. trade deficit with Japan. I think that's something that will have something to do with U.S. energy imports, Japan imports of energy from the U.S. And otherwise, it could also affect currencies. They didn't really talk about the yen too much directly, but I think we could see pressure from both sides to push for a slightly stronger yen, either to help U.S. exporters on the U.S. side or to help reduce inflationary pressure in Japan.
What about on the deal between Nippon Steel and U.S. Steel? Did they talk about it? Were there any sort of progress there?
Yeah, they did talk about it. We didn't expect Trump to come out in favor of an acquisition. We knew he was opposed to that. But they did talk about it, and Trump enthusiastically talked about Nippon Steel investing in U.S. Steel. Ishiba listened to that, and when he came back to Japan on Sunday, he was on TV, and he seemed to be supporting that idea as well. It seems that Japan's coming around to that. The companies continue to pursue a deal, but it seems that at the very top, in terms of leadership, there's kind of a consensus that a big investment by Nippon Steel into U.S. Steel would be beneficial to both sides.
Brian Fowler, our Bloomberg News senior editor, with the latest there out of Tokyo for us. As we head into this very short break, we'll leave you with a look at the Hang Seng Tech Index, which is extending its bull run. So from the lows that we hit back on January 13th, we're up now 24%. And we're now within 3%, or a good day away, really, from taking out the high that we hit back in October. Plenty more ahead. This is Bloomberg.
It's hard to debate that you've got a solid employment report. You know, there's some other indicators and jolts and otherwise that show maybe some modest softening, but boy, you got to look really closely to see it.
We actually think that some of the softness that might take place in the labor market could come forward or could come forth in the coming months.
January is a difficult month. There's a lot of moving parts. This is a mixed report. I think the conclusion remains the same. There's a very strong labor market. It's not going to change the Fed outlook.
For the Fed, all this does is say, just hold your fire, take some time, let things unfold. The economy is giving you the space.
The Fed's on hold, right? They are totally on hold right now. They're on ice. They may not move at all this year. It's probably a really high probability.
Some of our guests, they're speaking after U.S. employment growth moderated at the start of the year. And we also have the White House National Economic Council Director, Kevin Hassett, saying President Trump has a multifaceted trade policy that goes beyond just tariff. He joins Bloomberg to discuss the key factors in Trump's trade strategy.
You know, the bottom line is the first time I ever met the president, right at the beginning of 2017, that one of our first discussions about trade policy was about reciprocity. And so 100%, that's going to be a key factor in President Trump's thinking and his team's workouts from his thinking as we work forward. And when you think about, well, what is reciprocity? How should we think about it? Then a lot of people focus on tariffs, tariffs, tariffs. And if we look at just tariffs, then you'll see that our trading partners tend to have tariffs that are 2 or 3 times higher than our tariffs. And so, like, if we were going to be reciprocal, then they could come down or we could go up, but it would be a lot different trade policy. But the way I like to think about it is just think about the fact that we have a tax system in the U.S. that's fundamentally different than the tax systems everywhere else in the world. And so I had my guys a couple days ago just update the numbers I always look at, and we found that U.S. multinationals had paid foreign governments $370 billion in taxes because of value-added taxes and income taxes in 2023. And foreign multinationals operating in the U.S. paid the U.S. government only $57 billion in taxes. And so they have 3 times the GDP we do, you know, globally. We're about a quarter of GDP. And we're paying $370 billion, and they're paying $57 billion. And that's not reciprocal. That's something fundamentally different. And what President Trump wants us to do is to come up with a really smart program that includes trade policy, tariffs, and revisions to the tax code. And he wants us to make it work so that America's on a level playing field again. And the reason he wants to do that is not because of the numbers, it's because of the people. The people in America who don't have jobs because we're paying $370 billion a year in taxes to foreign governments in order to incent our companies to not create jobs here, but create jobs overseas.
Kevin, you
it's
did
just
mention
unacceptable
Europe,
to the president.
but it sounds like you're talking about Europe. What's the ask of the Europeans?
The president is going to negotiate with the Europeans. He's going to negotiate with everybody. And at the time when he does that, you'll find out what his asks are specifically.
National Economic Council Director Kevin Hassett there speaking earlier with our colleague Jonathan Ferro. And just turning to some breaking news now. This is reporting coming out from the Wall Street Journal that China is building a list of U.S. tech firms for antitrust probes, essentially expanding its toolkit when it comes to responding to U.S. tariff pressures here. Looks like Chinese officials may be targeting Broadcom, Synopsys, both of those companies with probes. That's again, according to the Wall Street Journal, Dave.
Yeah, well, I'm just looking at U.S. futures right now still up. We're coming off highs a little bit. We'll dig into more details from this, but I guess the broader theme here is really China is responding not so much directly with tariffs themselves, although they have that in place as well, but really more of the market access and these lists are concerned.
Interesting if corporates then become these key pain points for China rather than broad-based tariffs.
Yep, there we go. More on the story, plus other things happening. Oh, suddenly it's busy this Monday morning. Plenty more ahead.
To it.
Yeah.
It's 11:29 a.m. in Tokyo. Japanese markets going on a break in just a minute for their lunch. Taking a look, slightly, maybe a little bit down on the downside in Japan, although there was a bit of sort of optimism, a bit of reprieve around that discussion, the first meeting between President Donald Trump and Japanese Prime Minister. Dave, what else are we looking at today?
Yeah, I mean, so far, I think the point we were making earlier on with Brian Fowler out of Tokyo is Japan so far has managed to be the only one so far that is visible on the surface that has managed to at least avoid being part of the tariff firing line. Now, on that very note here, of course, in case you missed that, on Air Force One on Sunday, President Trump did say that on Monday it's 25% tariffs on steel and aluminum. Now, what does it mean for this 30-day reprieve period for Canada? Because you think of aluminum, it's really Canada and Alcoa that come under fire there. Iron ore is down. We were up earlier on. We're down about 1/5 of 1%. Some of your proxies as well. Aussie yen is on the way up. Equity markets to the bottom of your screens. ASX Materials Index. Okay, there we go. 0.6 of 1%. Rio Tinto is down about 0.8 of 1%. Okay, let's have a look at this chart. So on Friday, Taiwan actually released some export data, and interestingly enough, there we go, 500% pickup in January shipments to, that's a record amount, by the way, and that's something that doesn't normally happen. I think there's something else happening in the world as far as supply chains go. But yes, is this front loading? Or well, I mean, it surely is. And I think the Erica Tay out of Maybank Investment Bank, who joined us about an hour back, basically said, do expect this sort of thing to continue as companies try and figure out where tariffs will eventually land.
Yeah, absolutely. This whole issue about the shake-up, about, global supply chains, to some extent there's a feeling that, perhaps a lot of countries already started preparing. But actually, to your point, when you look at the chart like this, you can see that there's still a lot of reactivity and a lot of room for reactivity when it comes to policy making. And thinking a little bit more about that and this tariff story, the US president says he's going to announce 25% tariffs on steel and aluminium imports later Monday. He's also teased plans potentially to unveil reciprocal tariffs on countries that tax American imports. Let's take a closer look at the fallout of all of this with a panel of guests this morning. Parash Jain is Global Head of Transport and Logistics at HSBC Global Research. Also with us is Zoey, Wang, Director of APAC Infrastructure and Project Finance at Fitch Ratings. I mean, Parash, I just want to start with you. Thinking big, how much more disruption are we going to see when it comes to global supply routes, and what is the cost? What is the cost of all of that?
I mean, it's a continuation of a trend that began pretty much after global financial crisis. And time to time, all what we see is acceleration in those trends depend on the news flows or the deceleration. But the fact that the import, or let's say if you look at the U.S. import from the three major countries, Mexico, Vietnam, and China. So while the import from China has seen a steady decline, but that is more than offset by China's rampant growth into Vietnam and Mexico. So all else being equal, it's a reconfiguration of supply chain. Globalization is here and probably likely to be here. All what we will see is the goods will find another way to navigate, which means that supply chain will become more complex, which more often than not works well for the logistic companies.
Yeah, Zoey, I'll bring you in. What are some of the, I guess, the key metrics that we should be paying attention to as it pertains to, I guess, what this might mean for the financial health of some of the companies involved here?
Yeah, I think as Parash like to bring something about the overall supply chain problem, I can speak in some about the air cargo because I mainly cover the airports. For the airport side, we think the tariff increase together with like the removal of the minimized exemptions. So it is just like the suspended for the current, but we are still not see if it is going for the future. But we are seeing this will definitely have the reduction on the like the air cargo volume. But because you know the tariff will fundamentally pass to the customer side, and it will like dampen the consumer power and also suppress the consumptions. But in the long term, we are still thinking that it depends if the customer is willing to pay the tax embedded for these e-commerce products compared to the local products for these imported goods. So for the long-term packs, we are still willing to see. And for the companies, as you mentioned, like back to your questions, like we are still to see the fundamental financial healthy if they can like adjust to this macro like changes quickly and to manage their cost down and to make the financial healthy a little bit.
I mean, to Zoe's point there about, you know, whether or not companies are able to actually factor in that cost, I want to ask you about the China factor here and also about the Hong Kong factor. Of course, in the Panama Canal, we've seen a Hong Kong firm now sort of somewhat being lumped in as part of the quote-unquote China risk as viewed by President Trump. If we see this sort of US targeting of Chinese companies and Hong Kong companies and ports, how damaging and how disruptive could that be?
I mean, as I said, right, the cargo needs to flow. And the beauty about a lot of those goods are that either you have it or you don't have it. And what we will see is the reconfiguration of supply chain all the time. And the cargo will find a way. So, for example, if you talk about flow of coal or iron ore, I mean, if US pose restrictions or a duty on it, then the cargo will start to flow in other region. And that region's production capacity will then move back to the US. All in all, basically, yes, it will create an uncertainty, and it probably will be inflationary for the consumers. But from the global business perspective, I mean, they'll have to keep rejigging this and find opportunities.
But what happens if Chinese firms specifically are targeted? I mean, that's not then just a question of, you know, this idea that trade does get through, but potentially we have a limited pool of firms that are able to operate completely freely.
Okay, I mean, I'm not a geopolitical analyst, but all what I'm trying to say is that take trade as a classic example, right? And what we have been seeing over the years is that the Chinese firms have started to go global. The multinational firms have started to come out with the China plus one strategy, and then they are targeting their destination countries, right? So a lot of the goods that is destined for the US probably will make way from the firms or the production facilities in Vietnam or Mexico, while the China will continue to cater to the rest of the world, particularly the Belt and Road Initiative countries.
Yeah, I got a question for both of you, because Zoe, you mentioned that operational flexibility is really one of the things that we should be paying attention to. Is there enough slack in the system? Is there enough flexibility built into these supply chains? And a lot of the capex that went in during the pandemic, you covered a lot of that, of course. Is there enough capacity there? And also the same question to you in a bit, but go ahead.
Yeah, I think it's quite an interesting question because in the past years and even recently, we can see like some ports and even airports, they have like readjusted their capacity and they reallocate some capacity to some more profitable routes. For example, we have seen some starting to benefit some intra-Asia some transshipment, and that's quite promising. So basically, we are seeing that the company also like adjust to these macro changes, and they are trying to get profit for these more promising routes.
Parash?
Yeah, I mean, everything has a price, right? If the demand exceeds and the prices rallies, supply will come out of nowhere. I mean, we have seen during COVID, right, from no mass production to trillion of masks being produced. So at the end of the day, yes, it creates uncertainty in the shorter term, but if there is a price, then you will find the cargo following that trend.
Right.
And, I mean, do you have a base case in terms of what kind of tariff we might end up seeing globally? Are we even able to price that in when we talk about sort of global reciprocal tariffs, for example?
Well, I mean, I'm an equity analyst, and all what I've been saying to our investors is for at least the sector that we cover, chaos is good. because all what it chaos does is create a volatility on a day-to-day basis, and which means that you will see a demand and supply dynamics move all over the place, and that's the opportunities that probably many of the companies leverage on.
What assumptions are you making on cash flow among the companies that you cover, and how does that affect, say, financial credibility and stability? Yeah, go ahead.
I mean, it's all over the place, the amount of sectors that we cover. So structurally, we are quite long on the OTAs. We are quite bullish on the shipbuilding industry.
Okay.
We are cautious on the Chinese aviations. We are cautious now on container shipping, while we are turning positive more on the tanker. So it is the moving pieces. But some of the businesses are more structural, which is, for example, the Trip.com's business model or Indigo's business model in India.
And just the ratings trends for this year. Yes, go ahead. Go add to that too.
Yeah, I think this is case by case, especially like case by sub sectors.
Yep.
For example, like the airport, because airport have a very diversified revenue stream. It have aero revenue and also non-aero revenue, like the duty free and the advertisement and the caterings. So like even for the air revenues, it also have the revenue from the air passengers and also from the air cargoes. And even within the air cargo, it has the routes to Europe, to US, and also within the Asia. So basically, we don't think much impact on the overall like the airport's revenue because they have a very diversified base. So I have to say, like for the airports, the impact is not so much, but maybe for the shipping, like for the carriers, there will be much like the significant impact. So this is case by case and the sector by sectors.
Chinese New Year, Lunar New Year. Let's talk about that and what that means. What are you seeing as far as what are the implications of the numbers we've seen so far?
Yes, I mean, if you see that, and I was talking to someone just before this call, if you look at those 8 days or the first 26 days, then we have seen that air travel is inched up in a low single digit, but that's comprised of 20 to 30% of growth in the international travel, which means that off a very, very high base, the domestic air travel at least is plateauing. We have seen probably the road and rail is growing a bit faster, and that is reflected into the air ticket prices as well. So depending on the various sources, ticket prices has gone down as high as 5 to 15%. And in fact, if you look at the post-Lunar New Year period, then the Shanghai-Beijing route, the air ticket is probably 25-30% cheaper than the train tickets. And that's probably the dynamic that we are seeing. So domestic plateauing on a high base, international you still have a catch-up to do.
Right, and you guys cover Chinese airports as well, to your point there. What are the follow-through from the numbers you've seen?
I would agree, Parash. It's very in line with what we expected. The Chinese New Year's spring rush is spanning 40 days, and there is almost kind of a break to the historical record in terms of the trip on numbers. Around 9 billion trips is expected during these seasons. And beyond the numbers, one thing is worth highlighting, just Parash mentioned about international travel, because it recovered very great during the seasons, around 90% to its pre-pandemic level. And especially to the countries like the Asia's country like Japan, South Korea, and Singapore leading the ways, but the North American still lags behind. For domestic, just as Parash mentioned, that it's didn't see much growth because we also think maybe some diversion to the HSR, high-speed railway, because the people maybe think there's some real advantages for the high-speed railway because have stable prices and also very punctual schedule, and also the very easy checking process. So basically, we see some people shifting to the high-speed railway.
Yeah, and the railway is also right in the middle of the city, right? You don't have to get to the airport and then take the railway in. Ironically enough.
Yeah, it's very extensive. The network. It almost to the very second-tier, third-tier cities covers. Covers very, very right.
Well, since you brought it up, how much more investment do you think we'll see in infrastructure in China on logistics as well? Because it seems to be that it's been fairly extensive already.
Yeah, I think it's the growing investors focus in the infrastructure sectors in China because it's quite mature, and now it's still attracting a lot of the new capitals.
How are things funded now? Is it public or is increasingly more private debt and private credit?
I think both. And now still public is the main source, but they still encourage private sectors coming in. So it will be a very good combination. Sources.
All right, fantastic. Very final word from you. Earnings season's coming up. What else is on your mind?
Earnings seasons, capital return for a lot of those industries who are in the late cycle. The capital return will be a driving force. And whether the companies talking about the buybacks, companies talking about the higher dividends, that probably will take the center stage going into the results.
All right, fantastic. Happy Monday. Have a great week ahead. Parash Jain there, Global Head of Transport and Logistics at HSBC Global Research, and Zoey Wang here. To my right, Director of APAC Infrastructure and Project Finance at Fitch Ratings. Okay, there was some breaking news early on to tell you about that. We now have a little bit more details on Shein, and
Yes.
Vietnam is involved here.
Yeah, absolutely. So Shein asking some of its top apparel suppliers in China to set up new production capacity in Vietnam. The move aims to mitigate the impact of fresh U.S. tariffs on Chinese goods.
Yeah, this rejigging of supply chains, and now they're asking for this to be in place. And we've been trying to get to the bottom. There's so many moving parts to this e-commerce story, and this is really the back end of it, which you don't normally see, but it's a fairly important source of trade flows, isn't it?
Yeah, and I mean, interestingly, we even had a guest on Friday who was talking about how to sort of reroute trade. He distributes Korean cosmetics, in fact, and he was talking about trying to set up warehouses in the US, elsewhere in Korea, basically outside of Hong Kong, for example. So it is a story that we're seeing in many different ways, kind of really all across the region from Hong Kong and Chinese firms. But the specific focus here is this de minimis rule. Now, we've had a bit of flip-flopping about whether or not and when it's actually going to come into force. But essentially, it is this anxiety that Chinese companies may no longer benefit from this duty-free of shipping of small packages, $800 or less. I mean, even if we do have reprieve, it does look like ultimately, you know, this is something that Chinese firms are going to have to grapple with.
Yeah, all this uncertainty and all the breaking news in the last hour or so. Illumina is now in talks with China over this unreliable list on the broader theme here as well. And to the point Rebecca was making, we'll talk more about this in a moment here, that the journal reporting this hour that Chinese officials are also targeting other U.S. firms, including Broadcom and Synopsys, with their own probes. So plenty more ahead to talk about. Keep it here. Happy Monday. You're watching The China Show. Good morning.
Good morning and welcome back. So, busy morning, more breaking news. The Wall Street Journal reporting that China is building a list of U.S. tech companies that can be targeted with antitrust probes. Beijing has already said it's investigating Nvidia and Google over alleged antitrust issues. Bloomberg's tech reporter Annabelle Jewellers joins us for more and the very, very latest. Just explain, what are the key parts of this Wall Street Journal report?
Yeah, so this is, as you said, it's Wall Street Journal reporting, but it does seem at this point that China is basically just trying to collect as many cards as possible in the preparation to retaliate against Trump's tariffs or enter these negotiations with the US, essentially. So, as you said, we've already seen this antitrust approach being employed just recently. Nvidia, for instance, Beijing kicked off their antitrust investigation back in December of last year. That involves partially that investigation, looking into a 4-year-old acquisition that was previously approved by Beijing. Then there's also the opening salvos that we saw in Trump instigating these tariffs last week. And at that point, they also looked at Alphabet and opened that antitrust investigation again there. And of course, this is a search tool that hasn't been used in China going back to 2010. But there is that thought perhaps they're going to be focusing on the use of the Android operating system in China. So antitrust investigations underway into 2 major big tech companies. Now it's a question of which other ones are likely to be into their sights. And the Wall Street Journal reporting this morning that officials are looking at building a list of tech companies. Some of those on the list could be Apple, chip company Broadcom, and also the chip design software vendor Synopsys as well. So just 3 names that the Wall Street Journal is looking into.
The potential of, what's the risk of a backfire here, just in case we need to talk about that?
Well, that is sort of the big unknown, I guess. But certainly, I think if you think just big picture, FDI, for instance, into China, we saw that slide every single month over 2024. So this isn't going to be something that really encourages firms to enter into China to maintain their investment commitments. At the same time, the Wall Street Journal is reporting that officials in China just really want to get the attention of Trump officials. And you think about the inauguration day, who was there and who were we seeing? It was a lot of big tech company executives. So it kind of makes sense, I guess, from that point. But I do think that the risk of Synopsys being involved in this is particularly interesting because it actually has a $35 billion acquisition deal pending right now. This is actually for the software developer Ansys, but that would be an all-American deal. There are concerns, though, around competition and the supply of chip design, also light simulation products, and so it is a deal that needs approval in the UK, EU, and also in China. And what's interesting is going back to January of this year, our Bloomberg intelligence team was saying that China was likely to approve this acquisition of Synopsys by, Ansys by Synopsys. You wonder whether that is looking so likely today.
Okay, Belle, thank you so much for breaking down the very latest. China perhaps flexing a little bit of muscle when it comes to responding to some of those US tariffs. Bloomberg's tech reporter Annabelle Jewell is there. Stay with us. We'll be across that story and plenty of others. This is Bloomberg. The Chinese animated film Ne Zha 2 has been leading a rebound at the Chinese box office, grossing more than $1 billion in its first 100 days in cinemas. Let's bring in our China correspondent, Min Lo. Now, just give us a sense of the scale here. How big really is that?
It is a huge hit in China. It contributed to, I think, more than half of the box office sales during the Lunar New Year period. It is on track to be the highest grossing film in a single market. And the film distributor, Enlight Media, has seen its share prices up over 40% since the reopening of markets after Lunar New Year. And you can see the trailers there. The production quality is really top-notch, and you can see how China has really translated its experience from that massive gaming industry. They really translated it into the animated film industry as well. So people are talking about how, the producers had really high demand for production quality. It took 5 years to make, 4 months to make one of the scenes, apparently, according to what people are saying online. But there are a couple of things going for this film that made it really resonate with the Chinese people. First of all, it is based off a Chinese folklore that millions of Chinese would already be familiar with. And it's about this sort of demon child who has an uncontrollable destructive energy, but he became a tragic hero when he sacrificed himself to save his family and his community. But I think what the producers were really smart about, number one, the character has this sort of rebellious streak in the film. He says, 我命由我不由天. That is a quote that many people have been leaving in social media on the comments. And it means that my fate is in my hands and not in the hands of the gods. So there's this rebellious, that sense of individualism that perhaps is a sort of fantasy that many Chinese people feel about, charting the course of their own lives. And the second thing they did was to tweak his relationship with his parents. So instead of having a very strict parent, he had very unconditionally loving parents, which again is that fantasy, after having suffered from their, tiger moms and dads. I guess this is something that really speaks to the Chinese people.
Okay. It's a bit heavy for Monday, all of those things. I'm trying to digest it. So
just reconciling your childhood trauma here.
Yeah. Rebel child without the hero is actually my story. But Min, thank you so much, Min Lo, our China correspondent there. And really just, having your own fate in your own hands might also be the strategy for the Chinese economy, right? When you look at the cinema stocks, for example, dual circulation, improving domestic demand, reducing your reliance on external supply chains is really a sort of an undertone we've been talking about.
Beautiful segue, Dave.
Did you like that?
That was, smooth as ever.
Finally, we're in fifth gear as we wrap up the show. A couple of seconds left. We'll leave you to look at markets here in Hong Kong and up in mainland China. We are extending the bull run on the Hang Seng Tech Index, about an hour left in the trading session in the morning. And the CSI 300, as you can see, is flat, although turnover, we'll leave you to look at this, 30 minutes to lunch break, and we are on track, we'll see, to hit $2 trillion in turnover by the end of the session today. Plenty more ahead here on Bloomberg TV.